Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment. Well, hello, everyone. Jim, we are here, and we're going to be talking a little bit about alternative investing. We have a guest as we're going to bring on in a moment, but before we do, I wanted to point out a few things about alternative investing, if I may.
Sure. Take the lead.
Most of us have been taught as professionals, even non-professionals alike, that investing is a universe of stocks, bonds, and real estate. But elite investors know otherwise. It's really only a fraction of what you can invest in. So there's really broader choices, right, to help improve returns, reduce losses, protect from inevitable stock market drops, or I don't want to say crashes, but drops are probably good. But
so you're getting into the uncorrelated and correlated.
Yeah, uncorrelated investing for sure. But there's four things that I generally like to look at in alternative investing. It's generating higher income, reducing overall risk, enhancing long-term growth, and protecting the purchasing power from inflation. So we've experienced inflation. I don't think any investor that we work with wouldn't want to generate higher income, right? And also help to reduce their overall risk and have a form of what I like to call a form of insurance against stock market downturns. Now, currently we're in a market that particularly since the election, but even prior to that the market has gone up, significant gains. Is that sustainable? I think we're going to use the word again, cautiously optimistic about what's going to happen. But okay, so you need to be more strategic. We need to be a little bit more defensive. And I don't think anyone would argue with helping to enhance their long-term growth, depending upon where they are in their age and stage of life. Everybody wants to look at opportunities that they can get that may help on the upside of those traditional investments, protecting them more or less. And of course, protecting on inflation, because inflation causes a currency devaluation and can, look, the ultimate goal here is for us to help maximize our clients' returns, but maybe even more importantly, mitigate their overall risks. I'm sure you wouldn't disagree.
I don't.
Okay. So I'm gonna throw a statistic out at you that many people are probably not even aware of. But the endowment funds of the Ivy League schools,
yes,
how much do they invest in traditional stock and bond markets, in the domestic stock and bond
Very
market?
little, if any. Yes, I do.
You cheated. I must have told you once before. Well, going back some years, and it hasn't changed, but
No.
About 6% in the Yale endowment portfolio was in U.S. equities, and the Harvard was maybe 10-11%. Now that's probably changed a little bit, but the point is they're less than 15% overall when you combine stock or equity investments and bond investments or traditional overall investments. So where are they putting all that money to work?
In alternatives.
Exactly.
So
what are those alternatives?
It could be in real estate. It could be in wireless technology,
private equity,
private equity. There's all
kinds of things
out there that we're just now becoming aware of.
And I do think many advisors, and I think they realize that there are other ways in which to invest. But the old 60-40 breakdown of traditional investments, 60% equity, 40% in fixed income and cash, stock diversification, what does that mean? A lot of people look at the Morningstar model.
Mm-hmm.
I have in value, I have in growth, I have in blend, I have in small, I have in mid, I have in large. That's not real true diversification. And then the other, probably third big mistake is the buy and hold. I buy and hold. Now, I see less of that, but we go back because we've been around a few years. We're not going to tell anybody how many years, but buy and hold was big.
Yes.
But it's dangerous.
Yes.
So what we try to espouse is, traditional investing should be continued. You should do that and do it in setting up some, what I like to say, insurance policies, utilizing some defensive mechanisms. I think we had an earlier guest that we talked about using covered calls and options. That's a form of putting a defense policy in place or an insurance policy in place. I think the next thing is utilizing alternative investments for people.
How much do you think they should have in alternatives?
That all depends upon who they are. It's a great question. You can have 5% or 50% or anything in between. I don't necessarily, advise the higher end, although I have a couple of clients that are in there. I more or less inherited them. They already were in that high percentage, but they also want to be in it.
Mm-hmm.
And they could also be in it because they might have outside investments already. They might have real estate investments. It wasn't uncommon many years ago when I worked for one of the big banks in New York that people invested in real estate, but they didn't really invest in the stock market. Instead, what they did was they invested in bonds, particularly municipal bonds, because they were in a higher tax bracket. That was their idea of a diversification, but technically they really had a large dedication to their overall portfolio in alternatives in the form of real estate.
And there's nothing wrong with that.
No. But it depends upon a couple of different components too, because you have those that you have funds. Alternative funds could also fall under, you have to be an accredited investor, and there's a couple of rules associated with that, depending upon their income and their net worth. And then there could be investors that don't qualify, but could still get into alternative funds. And we could talk about that at another time, but they're called interval funds, which have some similarities to mutual funds. But today, we do have a guest that I want to bring on now, and he is going to talk about one of the alternative funds that I've actually used for a handful of my clients, and it happens to be in farmland.
Really?
Yeah.
That's awesome.
So we all eat.
Yes, we do.
As far as I know. And I think it would be a really fascinating conversation to have, to discuss how we could invest in farmland and what it is they do and how they do it, and where in the United States that they in fact do this, because it might be, some of them may focus on certain areas and others may focus on certain types of products that they are, produce that they're farming. So let's bring on our guest if we can. Chris, hi, how are you? This is
good.
Chris Chard.
Hi, James. Hi, Jim. I'm doing great. I appreciate you guys inviting me into your program today.
Oh, no, our pleasure. We really look forward to having this discussion. I hope that I led you in a little bit here, and gave you a good platform for us to get started. Perhaps you could start a little bit and just tell us what it is that a little bit about your background, and before we get into the fund that you are offering.
Absolutely. Happy to do that. And, I'm once again, my name is Chris Chard with Soar Farmland. I'm one of the general partners and one of the management side of this organization that manages an asset that's very near and dear to our hearts. We are located in Omaha, Nebraska, so right in the middle of the whole country. And we my background, I've been an investment guy since I got out of business school about 30 years ago, and dealing with a lot of the same things that you and James and Jim have, dealt with in your career, portfolios of stocks and bonds, and the utility of that, and things like a 60-40 mix in mutual funds, separate accounts. Done that, I've marketed that for decades. And several years ago, I had the opportunity. I've been a big advocate of this asset of farmland for almost my entire life. I've owned it. I married a farmer's daughter many years ago and have 4 children with her, and so I've been very intrigued by it. But while I was dealing through most of my career with stocks and bonds, I came to recognize the virtues of this asset of farmland that really make it like no other investment. And when I say, the virtues, I mean, it's an extremely stable asset, and wealthy people have relied on farmland, to preserve their wealth and generate income since the dawn of time. And it's really been only the last several decades where people kind of pushed away from that because it's not sexy. It's kind of dirty and gritty. They pushed away from that. And, until several years ago, it became somewhat fashionable for several noteworthy billionaires started, it became public information that they owned a lot of this asset of farmland, but it had been quite unpopular for a good number of years. But I guess, to answer your question, James, about, where my background is both, on the investment side and on the farmland side. Our group of 10 different people here in Omaha, Nebraska, are more singularly focused on just, buying farms right and managing them well. And we do that, primarily in a private fund, and we call Soar Farmland Fund. And our firm is named after, if you visit the capital of Lincoln, Lincoln, Nebraska, the capital of the state of Nebraska, there's an 18-foot tall brass figure on the top of the Capitol building that's called the Sower, and he's basically planting seeds, and so that's what that iconic figure is what we're named after. Our group has a deep fluency of knowing either most of my teammates either grew up on a farm or have somehow been drawn into having a deep affinity for this asset. But like I said, Jim, really and James, what we like about this asset is it has a stability like nothing else, in its how the value of it holds constant and grows over time, the income it generates. And we think, and as a group, and I think, James, I know because I've had conversations with you about this,
yes,
that you would be in agreement that there aren't a lot of people today that are thinking of this asset for the virtues and benefits that we think we know hold true about it. Its stability, the fact that you brought up, James, uncorrelated. We have white paper empirical research that show that farmland actually has a negative correlation to stocks and bonds. If you go back to a time period, not so distant past, if you go to when the dot-com bubble was unraveling back in the year 2000, the values of farmland over that time period went up decidedly. And then again, during the global financial crisis, the value of farmland went up when most assets, went down in value. Certainly most stocks did, and most stock benchmarks did. And then going back just a couple of years ago in the year 2022, same thing, where farmland went up in value when the stock market was going down. Typically, when the stock market's doing well, like a year like this year,
Right.
it does pretty well, and it pays income. But when it gets when things get tough, it really kicks in, and the uncorrelated, benefits and virtues of this asset really, really show people not just why you want to own it now because of how it appears in your portfolio, but why people have thought that this is a good thing to own if you go back, to the dawn of time. So that's probably a long-winded answer to your question, James. But we're doing that, like I said, from a company based here in Omaha, Nebraska, and we're just huge believers in the diversification benefits and virtues of this asset of farmland.
Well, that's great. I appreciate the response and the detail. There's, I'm a little bit more familiar with the fund than my colleague Jim might be, but just real quick, maybe you can tell us the size of the fund, both monetarily, but also how many acres are actually under management with the fund?
Yeah, sure. So it's so the size of the fund today is about $120 million. So it's and we've been, it's been in existence in this form for 5 years now. And today the acreage in the fund is a little over 17,000 acres. And but we're of the opinion, with our group now that we've developed a sizable amount of assets and a track record that we're very proud of showing people, and that number of acres, that we're kind of on the verge of getting the recognition of some of the large investors in this space, whether they're pension plans or endowments, as you'd mentioned, James. The endowment and foundation space is a very, very sizable amount of assets, and we're just starting to get the attention of those types of folks. So our expectation is that we have to be cognizant of where taking additional assets might not be beneficial to the investor base, and that would be a point where we paused or stopped receiving new LPs, new commitments. But right now we've got a great flow of new farms and new deals coming towards us, and our team, is very seasoned and vetted at this. So we're optimistic. Some of our competitors manage, north of $1 billion in a fund. And it's not a crowded space, but we know that it's doable. And some of my colleagues came from another fund that was actually bought out in its entirety several years ago, and that fund was stopped at approximately just a little under $1 billion. So we're dealing with an asset that's very scalable, and we see a very abundant pipeline of new deals to put into the fund.
Chris, what type of farms are you looking to purchase when you get involved with this?
Yeah, Jim, that's a great question, because generally speaking, there's roughly 3 categories that a fund like a private equity fund would consider buying into. The first category would be one of row crop, which is what we're singularly focused on. So think of corn and beans, and we actually have on some of our farms things like rice and cotton, sugarcane. But they refer to these types of crops as an annual crop, in that they're planted every year.
Right.
And that's something that we have a very deep belief that is the asset when it comes to farmland. That's really the core. That's the most important, the most stable, the most income generating, of all of them. Now, as you deviate away from that a little bit, there might be other managers that could you guys could interview that would participate in the second space that I would mention, and that would be called permanent crops. And if you think of vineyards, apple orchards, orange groves, crops where they're coming out of a investment of the plan itself. That's categorized as permanent, and we purposely stay away from that. We think that is, some other funds and managers have done quite well with it. It to us, it just it spells out a lot of risk, because there's risk in the amount of time between when that's planted and when you actually start generating income. There's risks that become quite evident to me with consumer behavior. What if you plant this tree and the type of fruit or nut it produces only after 4, 5, 6 years, or even longer in some cases? What if that becomes less popular with consumers, and then you'd have to go back and redo the whole farm? So we purposely stay away from that space. And then there's another portion that I would mention that funds can buy, which would be the foreign space, which mean investing in wheat fields in I would say several years ago I would mention the Ukraine. That wouldn't sound like a good idea. I think for a fund today to have that, but if you were to buy perhaps fruit trees in Spain, or wheat fields in perhaps Australia or something like that, the foreign component. And we look at that as a lot of risk for a whole bunch of reasons, whether it's currency or sovereign risk, land and title risk. We purposely take that out, and we don't have that in our fund. So we take the one type that we think is the preeminent farmland that you'd want to own as an investment, which is row crop, annual crop farmland, and we buy that. And something that I guess not part of your question, Jim, but I would mention, we think it's really important that along with that farmland that we're buying, that we get the water, and whether the water is very consistently falling free from the sky, or whether it can be pumped out of the ground. We want to have that water, and that's really, really important. One of my colleagues here says that when someone's dealing with the asset of residential or commercial real estate, they will typically have a mantra of, well, it's about location, location, location. And people on our team, I've heard them say, when it comes to farmland, it's about water, water, water. So that's a real key ingredient. As we buy a farm, does it have that water, and is that water sustainable? Quite often, the permanent crops, and you might think of something that's been in the news in the last year of almond orchards in California. They've had difficulty getting the water to be able to water their orchards, and that raises a risk. We won't buy in a place like that where it's really challenging and not sustainable to get water. So if you look at and this is probably another question that you, Jim, and James might raise, and part of yours, James, in the beginning was geographically
where are your farmlands? Yes,
we're in Omaha, Nebraska, but where are we buying geographically? And I can say it potentially across about 30 states, but predominantly through the Midwestern, what you call the Corn Belt. When you get into, here in Nebraska, we have a good number of farms in Nebraska. We own in Iowa, Michigan, potentially Illinois, Indiana, but also going through another part of the world part of the country that has a very high level of farmland productivity and has water would be the U.S. Delta and the Southeast. Mm-hmm. So where we own farms today are across about 7 states, and potentially as we get larger, we could potentially go across a large number greater than that. But we really need to have that, the common denominator of, great soil quality, because that leads to the productivity of the farm, and also that ingredient water, which, as you guys know, that's really important if you want to grow something.
So you gave us some of the states that you have that acreage that you're managing. I think one previous time that you and I had spoken, you had mentioned that Georgia was a big state that you were owning or looking to own. Is that correct?
That's absolutely correct, and we own a great deal of farmland in Georgia today. And because of the reason that I mentioned, people might not think of water when they think of Georgia, but the thing that Georgia has going for it, we can find very good soil in that state. But a lot of the farmland we own in Georgia, and potentially we could own in Florida, is over in a very abundant source of fresh water, which I would argue is the most abundant freshwater source in the North American continent, which is the Floridian aquifer. So we've liked Georgia for a number of years now, and we've been very actively acquiring, down in Georgia. And if you go onto our farms, which I have done, you can see that there often is irrigation equipment, and if you're driving across the countryside and you see these large, these structures made out of metal with wheels, they're what you're often looking at is a centerline pivot. So that is driven and fed by a well that goes down into the ground. And in Georgia, the water is delivered to it from the Floridian aquifer. So yes, that's exactly right, James. I mean, that is an area where we've been attracted to it for a number of years now, and we not just attracted to it, we've been buying there. And there's also a benefit that other than water and soil quality, Georgia has the price per acre is at a very significant discount to what you typically see in our home state of Nebraska or a state like Iowa or Illinois, which are commonly thought of as sort of the gold standard of row crop farmland anywhere in the world. This is some of the best are in the states of Nebraska, Iowa, Illinois. And Georgia's not very far behind with the fertility and the quality of the soil. But what they have that's an added benefit is they have a much lower cost per acre. So if you've been Googling and looking at the investment of farmland, and you look at some articles that have come out in the last several years, they will often refer to how expensive an acre in a state like Iowa or perhaps Illinois could be. And they'll refer to prices per acre of, say, $15,000, maybe even $20,000 an acre. Georgia, when we started buying, several years ago, just a fraction of that price. So, basically, we're getting a lower price per acre on the farm. We're getting very abundant water, and the next question we're usually asked, and when we talk about Georgia, is, well, what do they grow down there? And it's quite diverse. They grow some of the same things you'll see across the Midwest, where they're corn or soybeans. They also grow peanuts, which most people are probably familiar with. That they grow those, and then also cotton. There's a county in Georgia that is famous for growing onions. So some vegetable specialty crops also. But most of the farmland we own there are corn, beans, or peanuts, basically.
So it's very diverse. So we only have a couple more minutes, but I wanted to ask you a couple of quick questions. So we both know that investing in farmland is really an inflation hedge. And we would agree to that. So I guess the question that I would want to ask so that people would be aware of this is, okay, so it's not investing in farmland. I don't know that we would deem it to be, a sexy type of an investment, for a lack of a better term. So what are the returns that individuals could expect on an annual basis? And I tell my clients that this is more of an inflation hedge. You're going to get consistent type returns, but it's not going to be. We're not going for home runs and grand slams here. That we're looking for something that's really going to round out a portfolio of alternative investments. Would you agree with that?
Yes, and so it would be on the low end, but what it lacks in a robust return number is made up for in the stability. Obviously in the investment world, people will often quantify risk, using a standard deviation, and just to put it in perspective, the standard deviation on this asset is a third of what you see from the S&P 500. So what it lacks in really robust return, it makes up for instability. But to specifically mention, James, I mean, the numbers that that we talk about are high single digit returns, or the benchmark. There's actually, most people, I don't know why anybody be aware of this, but there is a benchmark for farmland, and both permanent crops, which I mentioned earlier, the vineyards and the orchards, and also row crop farmland. There's a benchmark that follows and tracks about $10 billion worth of farmland, and that benchmark hits a number of about a little over 10% over the last 3 decades. There's also places you could dig around and find longer track records than that go back 5 decades or perhaps even 100 years, and they all give you about the same level of return, which is the range of about 10 or 11%. So some people do think, well, that's a relatively low return in this day and age. Usually, when we hear people talking about that, it's right before there's kind of a reset, and then
Yes.
people are reminded, the old adage they say in the Midwest here, don't have all your eggs in one basket. I think folks have been kind of drawn into, certainly in a year like this, putting all the eggs in the Bitcoin basket, and not
AI.
thinking of things like you said, James, that are less sexy but have a track record, a history of stability that doesn't just go back years, but centuries, basically. That's essentially what we're targeting, and that's essentially what we've hit since we started our fund.
All right, very good. It's a foundational investment, and I think that people we will have these conversations with people to explain to them that this is an important consideration. And we want to thank you for your time, Chris. Perhaps in the near future we'll have you back. But we want to thank you again for taking the time out to speak to us about the Soar Farmland Fund. And we look forward to talking to you again in the near future as well.
Thank you, James, and Jim. Thanks for including me. I appreciate you.
Absolutely.
It was eye-opening for me, so thank you.
Thank you, guys.
Okay, bye-bye now.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com/disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy. Engage in any financial transaction and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on an investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only as of the date of the production or writing and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bell Point Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.